Yeah, this session actually introduces you to uh, the high level overview of the equity securities. I mean, what kind of securities are there in the equity market, right? When we say equity, is the most common thing we think of is common shares. But apart from that, what all are there, and what is the entire process? That entire aspect of the theoretical aspect of the equity securities is what we are going to look at in this session. So to start with, see, when we talk about equity shares, we talk about these many varieties. There is a common share, or there are some callable shares, there are puttable shares, there are preference shares, there are cumulative preference shares, there are participating preference shares. There are so many variants in terms of the shares itself. Whenever we talk about, the most common things we always talk about are either the common shares or the preference shares. These are the two common things which we come across. So whenever we are talking about a common shareholder, the most important thing for us is, in case the company is going bankrupt, first the lenders will take away the assets to the extent of their claim, to the extent of the loan which they have given. The lenders will have a take on the assets of the company. Anything which is left over is what is being taken over by the equity investors. That's where we always say equity investors have a residual claim. In case the company is winding up, or in case the company has gone bankrupt, or in case the company want to shut down, the amount that the equity investors will typically get is nothing but whatever is that portion of assets that is left over. That's where we always use this word, right? Assets equal to liabilities plus owner's equity, the balance sheet equation. See, liabilities are all something which are taken by others. Assets are everything which the company is, the monetary worth of what the company is having. So the difference between these two is what the equity investors are going to get, right? So that's where we say they have the residual claim on the firm assets. And most of the equity investors, they actually participate in the governance of the organization. They can enter as board of directors, so they have voting rights. We have looked at these aspects as a part of corporate governance chapter also, which we have covered earlier, right? And the difficulty side is they don't get a fixed return on their investment. If we are talking about a lender or someone who has given loan to the company, the interest is paid on a yearly basis, and that interest is fixed in most of the cases. So at least the lender will know how much he is going to get every year. But with respect to the dividend which has to be given to the equity investor does not know how much he is going to get, because the dividend policy, I mean, the whatever the dividend that is going to be paid every year can be decided by the management in that particular year. So in some years, if they want to retain more money, probably the dividend payment could come down. So there is a lot of uncertainty or variability that is associated with the dividend, because there is no legal requirement or legal obligation also to pay this much of dividend every year. Whereas in case of interest, at least if someone has not paid the interest, it can very well be treated as probably default, and it could even decrease the credibility and the credit worthiness of the company. But if a company doesn't pay dividend in a particular year, it does not decrease anything of that sort for the company. So that's where companies always show some kind of interest in terms of the dividend, in terms of equity shares. Then in this equity shares, we have a small variant. Of course, not every company will use that, but there are very few instances across the world in terms of two small variants in the common shares called the callable as well as puttable. Actually, these are more in line with the terminology of the derivatives, which is the options area. Callable is something which can be called back. The shares which can be called back, which is like a buyback of the shares, and puttable is the shares which can be sold back. So whenever we say callable, it means if it is a callable share, it works like this. When a company wants to buy back the shares, it's an agreement. See, today, let's say I'm issuing a shares, I'm raising new capital. The prospectus of this itself will clearly say that these shares are callable after 3 years. Callable doesn't mean that we will buy back. Callable means if we want, we will buy back. Otherwise, we will not buy. So the decision is with us. The decision is with the company. If it wants to buy back the share, it can very well buy it back at a fixed price. It can decide the price today itself. Probably 3 years later, we will buy back the share at 200 rupees a share. So when will they generally buy back? If the market price is, let's say, 250, the company thinks buying it back at 200 is a good option. So let's buy back and reduce the number of shares in the market. But if the market price is only 150 on that day, if at all we have to buy back, we need to buy it back at 200. Why should we buy it at 200? They'll say, okay, you continue as shareholders. But when the company decides that it wants to buy back, people have to sell it mandatorily. People cannot say that we will not sell. So that option will be there. If that option is not there, if people don't want to sell their shares, no one can do anything there. Right? Let's say if the option is there at the time of issuing of the share itself, if the company has issued a callable share, it means now the decision is in the hands of the company. If it wants to call back, it can very well call back. But if that option was not given at the time of issue of the share, it means, okay, if the company still wants to call back, the shareholders need to agree for that. If you have to make your shareholders agree for that, probably you may have to give some kind of premium or something for them. You may have to pay a premium or something so that you can call it back. But if you have issued a callable share, you can call it back at the price you have decided due at the time of issue itself. That's an advantage. So callable shares always have the benefit of issuer, not the investor, right? Because the company can call back whenever it wants, not the investor can decide. Whereas the puttable share is the other side. It gives the investor the right to sell off whenever he wants, right? So that's where you don't find many